All right. Good afternoon. Welcome to the grand finale of the Handsome Weeble tax update. Thank you for staying with us. And I may not provide any fireworks this afternoon, but I can guarantee we're going to get out on time. My name is Rich Wasowski, tax partner at Handsome Weeble. Assisting with the presentation is Brian Garrison, a supervisor and team member here at Handsman who has extensive experience in the not-for-profit world. So before we start our slides and presentation, we're going to go some the typical housekeeping, which we should all know by now. Please make sure that you're on mute and hit the link to get the CPE and the codes in front of you, as we'll be given the 3 codes throughout this session. Also, a reminder that this session will be recorded for future reference. Your participation indicates your consent for your voice and your image to be part of the recording. Please do not disclose any private information during the sessions. And if you're having a bad hair day, you may want to make sure that your video is turned off as well. So with that, we are going to start our presentation on UBIT, unrelated business income tax. The tax as a tax-exempt organization. The agenda is going to start out pretty basic. So there's going to be a lot of those in this session. I already see some clients attending that this is going to be pretty basic. We're going to discuss, what is excluded from unrelated business income, how you calculate it, maybe give some examples later that we see that gives rise to unrelated business income, and the effect of the tax reform. We have some rules with us since 2018 on how to calculate your unrelated business income, as well as the revisions to the tax forms. So again, this may be basic, but the background is that to eliminate any unfair competitive advantage that an exempt organization may have over any for-profit counterpoints, they have a specific tax on any unrelated business taxable income. UBTI, I'm going to say that because it's a lot easier than saying unrelated business taxable income. It's the gross income from your unrelated trade or businesses reduced by allowable deductions directly connected to that trade or business. Really, there's going to be 3 components of UBI. It has to meet the definition of a trade or business, has to be regularly carried on, and it cannot be substantially related to your exempt purpose. If you do not meet these components, then it's not considered unrelated business income. Okay, so trade or business requirement, production of income, sale of goods, or performances of services. I think a key is that there has to be a profit motive to be considered unrelated trade or business. So that's a fairly broad definition that will encompass a lot of examples. It has to be the type of activity that there's some likelihood of competition with non-exempt business. It doesn't have to matter if you actually have actual competition, but it has to be the type of activity that there could be a unfair competition. And this is a side, which I noted that the lack of a profit motive, the IRS has actually been hitting this area fairly hard in the last few years, in that if you continually every year show a loss, they may actually say that you are not in it for profit unless any loss carryovers going forward are not allowed to be used. So what is regularly carried on? what we would normally think is going to be a year-round basis, but it could be something as simple as a few weeks every year, but it's regularly carried on year after year. Think of the sale of Christmas trees by the Boy Scouts. They're obviously not selling in July Christmas trees, but because they do it on a continual basis, it's considered regularly carried on. Okay. Again, the seasonal activity is an example. Now, one of the keys is it's not UBIT if there's some kind of casual relationship to the achievement of your tax-exempt purpose. It's obviously going to be determined on your facts and circumstances, and the IRS would examine that activity. I think a key item to point out is just because it raises funds for your exempt purpose does not mean that there is a substantial relationship to that exempt purpose. And we just pretty much talked about this slide. I am going to, again, so that we can all get out of here, there is a lot more information and slides than what we will cover. So we may gloss over some of these slides, but I think they're a good resource to be able to go back to. Our first word for today is Bearcats. That's one word, like the Cincinnati Bearcats. Make sure you get that logged in, because who knows, if you're sticking it out to 4:30, 4:45, you sure want to make sure that you're getting the required hour of CPE. So Brian's going. So now we've kind of like, what does it take to be an unrelated business activity? And Brian's going to discuss a little bit of what is by code excluded from that definition. Go ahead, Brian.
Right. As Rich just said, I'm going to talk about the exclusions and modifications to UBI. So, first slide is going to be this. It's kind of overall just showing you the 4 principal exclusions, and then I'll dive into those. The same state rule, the convenience exception, volunteer labor exception, and the donated goods exception, or exclusion, I should say. Same state exception. I'm not going to go into this one too much. We don't see it a ton, but basically, if there's a byproduct of conducting the exempt function that's sold, it's not considered UBTI as long as there's no modifications used or done to those products after the fact. And here is an example of it. Like I said, I'm not really going to go into it, but it's included in your slides in case you ever want to kind of see what we're talking about for modified products versus non-modified products. Next is convenience exception. So this is essentially UBTI does not include income from a trade or business carried on by the organization primarily for the convenience of its members, students, patients, officers, or employees. A good example of this would be like a private school that has a school store. They're selling clothing with the school logo, or maybe school supplies, or maybe some snacks to the students and teachers. That would be excluded. It's for the convenience of those students and teachers and other employees, not really a driver to try to make money off of it. And this applies only to 501c3s, colleges, universities. Volunteer labor exception. So this is essentially saying if it's primarily volunteer labor that is the salaries or the people that are working for these trades, this trade or business, as long as 85% volunteer labor, 85% or more volunteer labor, then it's not considered UBI. Now, the only thing you really have to watch out for this is tips and non-cash fringe benefits, such as meals, are can be considered compensation. So therefore that would actually taint that 85% of volunteer labor if all of them are getting tips or some kind of meals for their work or anything like that. And another thing to keep in mind is this is 85% of the labor for that UBI or the questionably UBI related sales. So if you have 85% or maybe 100% is for tax exempt purposes, all of that labor doesn't count towards this. It's only the labor that's generating the potential UBI. Donated goods exception. This is just saying essentially if all of the goods that you are selling are donated, then it's not UBI either. Good example is thrift stores, Goodwill, Salvation Army, such like that. Sponsorship payments. This sponsorship payments are essentially businesses paying the exempt organization for some reason. If it's qualified, it will not be UBI. If it's deemed not qualified, then it will be subject to UBI. I'll kind of talk about what non-qualified is next. So first off, qualified are any payments by any person engaged in the trade or business with respect to which there is no arrangement or expectation that such person will receive any substantial return benefit. Then I'll kind of talk about what really is a substantial return benefit next. So substantial or something that isn't substantial would be just the use of the logo or just acknowledgement of them giving the money. So say a nonprofit organization holds an event and somebody pays them $10,000 to sponsor the event. And the only thing that they're really getting from that is their name is listed on their website of saying thanks to our sponsors, and it's like maybe Handsome Weeble or whatnot. Just that kind of acknowledgement isn't substantial benefit. Like on that same kind of a level, insubstantial value test, which would be 2% or less, benefit received for their contribution would also be a qualified, so it wouldn't be counted as UBI. So if the person's receiving something greater than 2% in fair market value, then it may be tainted and therefore may need to be picked up as UBI. All right, terms benefits may include advertising, exclusive provider arrangements, goods, facilities, services, or other privileges, exclusive or non-exclusive rights to use of organizations' intangible assets, such as trademark, patent, logo, or designation. Exclusive provider arrangement may be something along the lines of Visa paying the exempt organization to only accept Visa cards as payment, and an advertisement might be something along the lines of the exempt organization being paid to say something like Visa is the best card out there, or something like that on their website. So those would be examples of benefits that would more than likely taint the sponsorship agreement. The special rules, contingent payments are always deemed to be non-qualified and thus UBI or subject to UBI. Contingent payments could be something like, once again, I'll use Visa. If Visa came to an exempt organization and told them, if you set up a Visa booth at your football game and we'll pay you $10 for every application that's filled out during that football game, that'd be contingent on how many people actually signed up, and therefore that would be tainted as needing to be picked up as UBI. So another thing, qualified sponsorships, if it is qualified sponsorship, it will be considered contributions and, like I said, not subject to UBI. A few other takeaways along these lines are you should always have any sponsorship agreement read or reviewed before you sign it, just to make sure that any of these issues that might be included in that agreement can be addressed prior to actually needing to file. And also, if there are portions in those agreements that could be maybe seen as qualified and some portions that are non-qualified, you also want to maybe think about getting those broken into two different agreements. So say, once again, with Visa, if they wanted to sponsor the event with $10,000, then maybe have that as one agreement and then just acknowledge them on your website. Because if they also included in that agreement, like I said, a contingent payment portion of it, if they break it out into two, then part of it you could call contributions, and then part of it would be subject to UBI instead of tainting the entire thing. Some other statutory exclusions I'm not really going to go into, but here they are. I'll talk about modifications. So some principal modifications, which essentially means these are excluded just kind of right off the bat. Interest and dividends, royalties, rents, and for the most part, gains and losses from the sale, exchange, or other disposition of property. This isn't every single one. There are some exclusions for this, or some that would actually be tainted. Income from research activities, and I'll mention that income from S corps is just always treated as UBTI, and one of those exemptions or the exceptions that I mentioned earlier is if you sell your interest in the S corp, the gain or loss is subject to UBTI. All right, passive income. Generally, passive income is not considered UBTI, such as interest, dividends, annuities, royalties, rents. But there are several exceptions. Income received from controlled organizations, with the exception of any dividends from those controlled organizations. And income from debt finance property, which Rich will go into a little bit more detail about later on. Royalties, I'm not really going to go into, but once again, slides for your review later. And now turn back over to Rich for rental income.
Thanks, Brian. So the general rule is that if you're receiving rental income from real property, it's going to be excluded from UBI. And rents from personal property are not excluded. And there are exceptions to the exceptions. If your rents are based upon a net profit of the property, then it does not meet the rental income exclusion. Similar to sponsorships, if you provide substantial services as part of the rents, that will taint it, and all of the rents will be subject to UBI. And if rents are derived from a controlled corporation or debt finance property, then a portion or some may be considered UBI as well. And we'll get into that a little bit more. So a lot of times what we see are mixed leases. So think of a historic building foundation that rents out the backyard, the garden for weddings. As long as the rents, all you're renting is the use of the garden and facilities, that should be excluded from UBI. If the organization provides the chairs, the tabletops, etc., so you're basically leasing some personal property along with that, then that can possibly taint the rent. So the general rule, if your rents are 10% or less of the total rents are for personal property, then you pretty much ignore the personal property, and all of it would be excluded. Where the rents are between 10 and 50%, only the rental income attributable to the real property is going to be excluded, and if the rents are greater than 50%, none of the rent is going to be excluded.
Rich, you have a question if you didn't see it.
Is rental of parking spaces considered rent of real property? and therefore by statute excluded? I would say yes. Yeah, I mean, that would be my position, Diane. I've not really run into that, but I don't think it would fall under the definition as personal property. So again, in summary, if personal property is less than 10% or equal to 10%, all of it's excluded. If it's greater than 50%, then none of the rents are going to be excluded. And if it's somewhere in between, you have to do an allocation. Rents from based upon net profits, which we don't really see that much, but that would be also not excluded. It would be subject and treated as UBI. So if you have a percentage of the gross receipts or sales. Another area that we see a lot is when we get the review in advance is if you're providing services as part of the rent of real property, that could taint the rents and make the rents also UBI. If it's more for the convenience of the tenant, then it tends to taint it. If you're a commercial building and you're providing the janitorial services for the lobby and all the common area space, that's expected and that would not taint it. If you go into the tenant's space and empty their trash and clean their space, that's more of a convenience for that tenant, and that could taint the entire rent payment and make it subject to UBIT. So again, maid services, janitorial services. So and as a takeaway, this may be something again that you consider having two agreements, the rent of the property as well as maybe a side agreement where you're being paid to provide personal services, so that way the personal services doesn't taint the rent payments. Okay. Income from controlled corporations. So this goes back to about 2006, I believe. And as Brian mentioned, the general rule is passive income, interest, royalties, rents. It's going to be excluded from UBI. But if you're receiving these type of passive income from a controlled corporation, and we'll talk a minute later about what is considered controlled, to the extent that these payments that they're making is a deduction against their unrelated business income, then you have to recognize it as unrelated business income on your side. So they can't deduct rents paid to you to reduce their overall unrelated business taxable income without you picking it up as UBI yourself. So, and this also applies to not only controlled tax-exempt or not-for-profit organizations, but it can also apply to income received from controlled for-profit entities as well. Control is pretty much more than 50% of either the stock, a partnership, or capital interest. If control for another nonprofit, it's going to be generally if you can appoint or remove more than 50% of the voting power of the board, or place more than 50% of the board trustees or board members you consider to control that organization. And then you have to look at attribution and constructive ownership. So looking at spouses and family members, et cetera. So. Yeah, and as Brian just mentioned, generally if you sell property, stocks, securities, land, whatever, by the organization, it's not going to be subject to UBI unless it's like inventory by the organization or that's held in an ordinary course of business. And if you have debt financed property, which again we're going to get to in a bit, and you end up selling that property, a certain percentage of that gain may also be subject to UBI. Brian just mentioned that if you have income, you're getting a K-1 from an S corporation. It does not matter what type of activities in that S corporation, 100% of that income or loss allocated to you will be subject to the UBI rules, including if you have any gain or loss when you dispose of that stock. So for all of our not-for-profit attendees, special care if you're going to receive a gift from a shareholder in S corporation and they want to give you their shares in the S corporation, you have to look really hard at what it does for your unrelated business income. Debt finance property. Okay, so there is a lot here that we're probably going to, I won't say gloss over, but we're going to go fast. So if you have property and there's debt on it associated with either purchasing the property or putting improvements on that property, and you're receiving rents, or well, we'll get to other examples, a portion of that income will be considered debt financed, and it will be subject to UBI. So as we just mentioned about rents, if it's a received and there's no debt on the property and there's no services or anything like that, it's that rents are not subject to the unrelated business income tax. However, if that property is debt financed, then a portion in proportion to the average basis and how much of it is financed. So again, something to be careful about. A lot of people were not aware that by having the debt on the property can generate some UBI. The deductions that are directly connected with the property are also allowed in the same proportion, and depreciation's got to be computed on the straight line method when calculating. There's the substantial use. So even though there's debt on the property, if 85% of that property is related to the organization's exempt purpose, then you disregard the debt finance and it's not going to be subject to UBI. If it doesn't, if you don't meet the 85%, then it's not considered substantially related. An example is a hospital has a 10-story building. There's debt on the property and they lease out one floor. Since at least 85%, that's 9 out of 10 floors, is 90%. And that is being used to carry out the hospital's exempt function, then none of the rental income will be subject to debt finance rules. There's no prescribed method for determining the use. Square footage, in this example, 9 out of 10 floors. I would say if you have a situation like this, I would use whatever methodology gets you the best answer. You just need to be consistent from year to year, and you can't flop around from one year to the next. And we also we see examples where an exempt organization may lease extra space to another exempt organization, depending upon the exempt purpose of the lessee. That may be enough to say it's not subject to UBI, that it's substantially related to your exempt purpose. We're really not going to hit these, but there are some other examples, run into them quite a bit. So we'll go through that. We're not going to get into the detail of how to calculate the average adjusted basis and what have you. So Brian, I would say let's just flip through these pretty quick. these are pretty detailed. So I would say, if you have time and you can't sleep at night, go back and take a look at this. But so the key is, what is acquisition indebted and what isn't acquisition indebted? Obviously, if you took out debt to acquire or do an addition or an improvement on our property, and the only reason you took out that debt is to acquire or improve it, then it's going to be acquisition indebtedness. And that can even mean if you're anticipating that you're going to purchase a building or what have you, and you take out that same thing. If you would not have taken out this debt otherwise, then it's going to be considered acquisition indebtedness. So, and there's special rules if the purpose of use of the debt changes. Again, this is something that you can go back on your leisure to take a look at. And what we normally see is you go out and purchase a property, but occasionally, if a property was gifted to the organization, or there was a bequest and there was debt associated with it, then it would not be considered an acquisition indebtedness. More importantly, is what don't you count as acquisition indebtedness? And again, with a lot of our organizations, it's really any debts incurred to perform its exempt purpose, lines of credit, perhaps PPP loans. Again, what was the purpose of taking out the indebtedness? And if you can tie it to your exempt purpose, then you would not have to treat it as such in your calculation. And we're not going to spend much time, but you basically, you look at the 12 months in your year and you say, what is the average balance of that debt? And then you compare that to the average adjusted basis of the property being leased. And if it turns out that 50% of the average basis is considered having acquisition indebtedness, then 50% of the rental income is going to be considered unrelated business income, and that same percentage applied to the expenses would also. So it doesn't taint the entire, but it's a percentage. I'm just going to take away from this. If you sell debt finance property at a gain, keep in mind that a portion of that gain will be subject to UBI. The only exception is if it's paid off more than 12 months before the sale of a property, then none of the gain is taxable. So if you pay off the property and you hold it for another 12 months and then you sell it at a gain, it's not going to be subject to unrelated business income. And we're not going to get into these examples, Brian, because I promised everybody we'd get them out of here on time.
All right, I think this is back over to me for computing UBTI. Here's a little graphic over simplification of it. First income, less direct connected deductions, less specific deductions gets you to UBTI. 3 baskets of expenses that'll go into are directly connected to, exempt related expenses are not deducted, and then dual use are allocated. This. All right, so as I've just said, deductions that can be directly linked to the unrelated business taxable income amounts are deductible. And then, kind of as I said before, anything that is directly related to the exempt functions, including management, general, and administrative expenses and fundraising expenses that can be linked to the general exempt activities cannot be deducted from the trade or business income that's deemed UBI. Dual use of facilities personnel. This is where you get into kind of allocating what portion should be allocated to the exempt portion and therefore not deducted, and what should be allocated to the UBI portion and therefore deducted. Here are some examples: depreciation, personnel costs, rent, utilities, maintenance, and some reasonable allocation examples or methods. Hours spent for like personnel, like 85% maybe working on the exempt purpose and 15% on the unrelated business income portion. Square footage of the building, as Rich kind of mentioned on his rental example, and then gross receipts.
So again, Brian, my experience if you're unfortunately having to sit down for an IRS agent across the table, it's really good that you're consistent with your methodology from one year to the next. And if you flip-flop, 1 year you do it based upon time, another year you do it based upon something completely different, then it's harder to win your argument with the IRS on your methodology. So, and
Yeah.
for those who are wondering, the second code is coming up soon.
I was gonna say, yeah, and I'll also mention, I mean, for the nonprofit audits that I go through, we already kind of have to do this allocation of time spent, square footage, and that sort of thing to break it down into the categories of program, G&A, and fundraising expenses. So it's already kind of done. It's just taking another step to exempt versus non-exempt income. All right, common scenarios that give rise to UBI. Gift shops substantially related to the exempt purpose, promote welfare of the patients, for example, it would not be picked up as UBI. Same as what I said before of the convenience exception. So if it's anything for the convenience of employees or visitors. Things that could taint these are if it's competing with a for-profit business. I feel like it could be kind of hard to really distinguish some of this, because like I said, convenience versus is it competing with a for-profit business. I think you could get into a little bit of gray area there. So it's always good to consult tax advisors or somebody of that nature to really determine whether it is UBI or not.
So Brian, going back to what you had originally on the bookstore in a private school, school supplies, you sell t-shirts or sweatshirts with the logos of that school. That's for the convenience and excluded. But then if they sell apparel that says Nike or whatever, that's not related to the school, then that normally would be considered subject to UBI. So again, a lot of this, it's more of a fuzzy gray area than, absolute one way or the other. So just.
Yeah. Management and administrative services. As I'm going to go a very base level. Generally, they're considered UBI. Do that real quick, unless it's provided to a closely affiliated exempt organization. I'll kind of go into alternative investments. So here's some example of what you might see as alternative investments: hedge funds, private equity, venture, commodities, those sorts of things. And a lot of these are structured as partnerships or similar pass-through entities, which can be kind of good in some cases, because they spin off K1s that are required to actually tell you what portion is UBI. So if you do have any of these sort of things and you know that they're partnerships, or you think that they might be partnerships, you definitely want to be requesting those K1s to provide to your anybody that's preparing your tax return, so that they can determine whether there is any UBI that needs to be picked up, or also if there's any foreign reporting activities, because you definitely want to pay attention to the foreign reporting activities as well, because if you're required to put anything on a Schedule F, then if you're not doing that, they carry very high penalties. As mentioned before, operations of trade or business, borrowing to make investments, flow through from other investments. These are just ways that alternative investments can spin off UBI. UBTI information by partnership. This is just saying what I already said. The K1s are required now to show what's UBI so that you can easily determine it. You're not just staring at a K1, not really sure what number to pick up as a UBI and what numbers can be excluded. And as Rich said, here's the second word, upset. Next, talk about the effect of tax reform on UBI.
Thanks, Brian. Go ahead.
UBTI to be separately computed for each trade or business. So this is one change. So prior to this change, well, it's actually the major change. I shouldn't say one change, but the major change. Prior to this change, pretty much all UBI was bunched together. So you come to one number, you have your income from certain unrelated businesses, less all the deductions, and then the losses from the losers and the gains from the winners kind of come down to one number to figure out what you're actually being taxable on or taxed on. So new provision. Now these are separated into silos, and I'm gonna leave it at that for now because Rich is gonna get into that in more detail after this. And some other changes are NOLs after January 1st, 2018 can now only offset 80% of UBTI in the same silo that generated that NOL. So kind of like I was saying before, if the NOL is in one silo and you have some winners in another silo, they can't offset each other anymore. And also with that being said, even if they're in the same one, if one year you have a huge loss and the next year you have a huge gain, it's only 80% now. Now, another thing to note is NOLs prior to January 1st, 2018 can still offset 100%, and they're also not restricted to a specific silo. So if you have some carryovers before the law change, these can be offset against or offset any income from any of the silos, and they actually need to be used first. Key takeaway, I kind of already said this, but it pretty much, you may have going forward now businesses that had huge losses in the past and ones that had huge gains, and it came down to you not owing any taxes, and now you might find yourself having huge losses that just continually carry forward, but also having to pay a pretty hefty tax balance if they can't be offset, the winners that you have. All right, now Rich will talk about this.
Great. So what we've discussed up until now is if you have an activity or a source of revenue into the non-for-profit, what is considered UBI or not. So when we get to these changes that have been in effect since '88, now we're saying, how do we calculate our taxable income, our unrelated business taxable income? And as Brian said before, everything was aggregated, so you're able to have, if you had multiple activities, your winners can use losses from other activities to offset and reduce your tax liability. Now, what's referred to as the silo effect, we've already made that determination that's UBI. Now we have to put it in the correct silo. And basically, the IRS is saying we're using the 2-digit NAICS code, to identify your separate unrelated trade or businesses. These codes will actually be reported on the 990Ts now. You can only use one 2-digit code once. So if you have multiple activities and two of the locations or activities fall under the same NAICS code, you can put them in the same bucket, the same silo. And You really, once you've made that determination, the only way that you can change its NAICS code is by disclosing it on the 990T that you've made a change. So go to the next slide. So again, you can only use the NAICS code once, which is a good thing. If you have multiple activities, especially some winners, some losers, and you put them in the same silo, you may end up with lower UBTI. What we see a lot are investment activities that are throwing off UBTI. So what we see is a lot of partnerships that are providing this information, and the IRS says that if it falls under rules of being considered a qualified investment activity, then you can treat it as one silo. But to do that, you basically, your interest in the capital or profits is no more than 2%. Or if it's more than 2%, it's not more than 20%, and you don't have any kind of significant participation in that partnership. So if you're a general partner in a partnership, you will never be able to fall in that rule. So if you're qualifying investment activities, you can lump them together into one silo. If you have a investment that is not considered qualifying, then it has to be treated as a separate silo. And then there's aggregation rules with ownership determining 2%, 20% if you're a supporting org, or you have a supporting org. And also, this qualified partnership investment may have look-through requirements. So if it's a fund of funds, and you may have to look through your partnership interest to see what, and hopefully this information is provided on the K1, but if it's invested in any other partnerships, you may have to add. So if you're invested in 3 fund of funds and all 3 are invested in similar partnerships, you have to aggregate the ownership together to determine if it's a QPI or not. Each controlled entity, again, we talked about UBI from controlled entities. Each one's considered a separate unrelated trade of business. Each S corporation is considered a separate trade of business unless it falls under the same rules for ownership as the partnerships. And you aggregate all your UBI from a single S corporation that is not a qualifying S corp. You don't have to look through to what it invests in. So calculating unrelated business taxable income, you first have to assign the NAICS code, and actually for each silo you have to do a calculation what the net income is. As Brian mentioned earlier, looking at deductions, you may need to do an allocation between what is exempt purpose deductions and unrelated business income deductions. Well, here you have to go down one more level. You need to allocate those deductions among the different silos that the organization has. You basically calculate the UBTI for each one. It cannot be less than 0. And then once that calculation's been done, you aggregate them together and it gets reported on the front of the 990T. So that way, since it can't be less than 0, the losses from one activity cannot offset income from another activity. So, go ahead, Brian. The only thing I'm going to say about the deductions is any reasonable method. There's really no further guidance available at this time. So. We also mentioned the new 80% limit on using the future use of NOLs due to COVID and those rules, the CARES Act and what have you. NOLs that are generated from from 2018 to 2020 are not subject to the 80%. So you have 3 years there of losses that can be used going forward at 100%. You basically cannot carry back NOLs unless it arose among those 3 years, but they can also be carried forward indefinitely. So, and as the third code word is Alabama. So some of you may notice the theme in these 3 codes. Brian, you're going to wrap things up with the revised 990T looks like?
Yeah, I'm definitely not going to spend much time in it because we're at time already. But the main takeaway, other than what we already talked about, is now e-filing is required for 2020 returns. I actually think this is a good change because now we don't have to try to get paper copies to clients to sign and then mail out by 3/15.
Yeah, and then the other key is there's a new Schedule A for the 990T, and the Schedule A actually sort of looks like what the old 990T itself looked like for prior years. So on each silo will file its own Schedule A. They get attached to the 990T, and then again you aggregate the net income from those Schedule A's and carry it to the front of the T. And with that, I know we ran through it pretty quick. Both Brian and I are available. If you have questions, you want to reach out to either of us. If there's something you'd like us to discuss with your organization. And other than that, have a great weekend.
Yeah.
And thanks for sticking it out.